All right, so Ari, you call UPS one of the most out-of-favor stocks in your coverage universe, but you have a buy rating and a 112 price target, pretty significant increase from where the stock's trading at right now. What are you seeing that everybody else isn't seeing?
So I heard your intro, Frank, and to some extent, the sell-off is kind of why we like it, right? I mean, the stock has gotten exceptionally cheap. Right now, UPS is trading at its biggest discount to the S&P 500 in history. It has almost an 8% dividend yield, and so it's a really robust dividend. And frankly, to us, we're like, look, the stock is almost being priced as though this is a company that faces existential risk. And we just don't think the challenges are that level of severe. We'll learn in an hour how they did on the quarter. But look, fundamentally, this is a company that's essential to the global economy. And it's not going anywhere. It produces enough free cash flow, we think, to cover the dividend. And over time, they're going to fix some of these problems related to costs and related to shrinking their footprint with Amazon. And as they do, I think the stock has a lot of room to move upward.
All right. You've written a lot about the administration and its impact on tariffs. One of the things you've been watching is essentially the Department of Transportation enforcement of English language requirements and also citizenship requirements when it comes to truck drivers. You believe as many as 200,000 truckers could be impacted, possibly taken off the road. Also, we have tariffs that are going to be put in effect on imported trucks. How is UPS impacted by either one of these?
So this is a big deal in the transports world, right? And so we've seen clearly the Trump administration stepping up enforcement of some of these rules around CDL enforcement, around English language proficiency for truck drivers. We're in an environment really where we've been dealing with this kind of long hangover from COVID. And now we're getting to a point where the supply-demand balance is almost at equilibrium in trucking. And this has the potential to really tip it into undersupply or undercapacity. And so while it's not entirely clear yet in the data, we think as we move into 2026, this could really cause trucking rates to start to move higher. So certainly good for UPS, but really good for the broader transports landscape, which, as you know, has badly underperformed the S&P over the past 2 to 3 years.
All right, so Ari, we call FedEx a bellwether sometimes, we call UPS a bellwether sometimes. I mean, straighten us out on this one. What in this UPS report will give us a read on the broader transports or just the freight and the shipping economy? Is there one part of this report?
So it absolutely is a bellwether. We stick to that. Now, it's not necessarily a bellwether of the broader market, but we think it's a good bellwether of the economy in the sense that, look, that the tariff impacts are very clearly flowing through into UPS, right? And so when we look at their international segment specifically, and it's really nice because UPS separates out their domestic and their international segment separately, whereas FedEx doesn't quite do it for us in the same way. And so it's a little harder to tell in FedEx's results. But for UPS, you'll be able to see very clearly what the impact is of those tariffs, how much additional cost they're taking on to reposition assets in response to some of the tariffs. And then domestically, as you said, look, UPS is one of the largest unionized companies in the country. And so you'll see how that's flowing through to kind of blue collar employment. And I think you mentioned it in your intro, but they have this plan to cut 20,000 jobs. And that's kind of putting a squeeze on some members of their workforce. And at the same time, UPS tends to pay very well. So these are really high quality blue collar jobs. So it'll be interesting. It's always interesting to see kind of how that tracks through to the broader economy.